Can you envision a world where you and your family in America and those who immigrated from Africa and the Caribbean could receive immersive financial education and invest in fractional and whole shares of U.S. publicly traded companies? That time has come. Wakeza. Finally, from your mobile phone, you can start investing in building wealth. Wakeza. Just sign up for the Wakeza app and join the Wakeza community to receive ongoing adult and youth financial education from licensed advisors. Wakeza. You become a financially educated and protected investor. Wakeza has one empowering objective: creating financial inclusion and your family's generational wealth for the African diaspora. Wakeza.
Hello, I'm Sabrina Lamb, the founder and CEO of Wakeza, and founded World of Money, the leading provider of immersive financial education for children. So Wakeza is for adults, for families. After all of these years, 18 years leading World of Money, I've heard from so many adults saying, well, what about us? Well, although Wakeza will provide financial services, we believe the first tiptoeing into this very powerful currency called money is through education. And because I believe that everyone should invest and no one should invest without a strategy, tonight, this next 30 minutes, 45 minutes, I'm definitely going to entertain your questions, bringing in one of the most powerful, passionate advocate of not only investing, but how we should think about money and actually hitting the reset on this engagement that's going to actually impact us for not only our entire life, but that of our families. So this evening, please welcome Dr. Dominique Reese. She is the owner of Reese Financial Services and Training Solutions and creator of Master My Money. She is a personal finance expert, coach and strategist, speaker, educator, author, blogger, and consultant with over 10 plus years of experience in the financial services industry. She has an economics degree from Princeton University and was a former Merrill Lynch advisor where she managed $4 million and was the financial planner specialist on her team. Dr. Dominique believes that literacy and legacy are all hallmarks of life, and she wants to help her clients as well achieve both, not by creating a foundation for wealth through money mastery. Hello and welcome to Planet Wakeza, where financial education and financial legacy is our culture.
Woohoo! Thank you. Thank you. So glad to be here as always.
Now, Dr. Dominique, we also have to share that Dr. Dominique has also taught at World of Money, and she is just a treasured, born, natural educator for children as well as adults. So I just want to publicly just thank you. Everyone loves Dr. Dominique, whether it's in Senegal or right here in New York City. So thank you for that. Now, you also have a lot of letters after your name, your last name. But that's really important. So when we're talking about strategy, everyone, we really need to be able to interview and understand the credentials of who we are potentially hiring or consulting. So if you would talk about your credentials and maybe a distinction of a financial advisor, and you're more than those who just cranked up a YouTube page and just giving out all this financial advice, and should not be, it's unethical. But share with our audience the distinction and what you are legally and ethically obliged to provide.
Yes. And I love this topic because I think in this marketplace, especially in this economy, it is quite important to understand who you should be working with so that you don't think you shouldn't be working with anyone. So as you've mentioned, I am a financial coach, consultant, and strategist. I carry two specific designations in this role. that empower me to support my clients holistically. One is the Accredited Financial Counselor designation, the AFC. The other is the Financial Fitness Coach designation. And then I am currently in school to complete my Certified Financial Planner designation, which really puts me back into a planning and somewhat advisory role. But as I am now, the work that I do consists of coaching and consulting, and I help my clients with a lot of things regarding their money, particularly around their financial foundation, where I can coach around goals, I can coach around behavior, definitely around content and education. So, educating clients about things, but building strategy, holding my clients accountable. Now, how that is different than the work I previously did and am coming full circle back around to as a financial advisor was that most financial advisors are licensed through the SEC, the Security Exchange Commission, which basically means once you get licensed, you are either managing money on behalf of your clients and or able to place trades and conduct transactions on behalf of your clients. And so in this capacity as a financial coach, consultant, and strategist, even as a financial planner, I am not licensed to do those transactions. Basically, I'm licensed to do everything else. I'm credentialed to do everything else except for manage money and place trades and technically give investment advice. There is a fine line between what we can do as financial professionals when it comes to advice and even that word. So, to put that into, well, what's in it for me terms, really, when you think about your financial situation, you want to say, well, where am I financially? If I have assets, especially liquid assets, and I am in need of financial support, money management, or guidance, you may be eligible based on your asset level to work with a financial advisor. However, if you find that you do not have assets and you're focused on building your financial foundation, which for me includes your mindset, budget, savings, debt, credit, income protection, and then your financial action plan, if that's where you are and you're building assets, then working with the financial coach and even a planner based on that particular planner is where you would need to be to get the support you need to manage and grow your money.
Would you share what does it mean for the different designations having required to have a fiduciary duty to serve the client?
Great question. And this can become quite controversial in our industry, believe it or not. However, when you have a fiduciary standard or responsibility to uphold as a financial professional, and let me be clear, every financial professional does not have to be held to this standard. Particularly, it is enforced by those who are licensed financial advisors, particularly because they are managing money. However, it is my belief that as a financial professional, you should hold yourself to that standard regardless. But let's be very clear, we know that all professionals don't. So, in that fiduciary standard, you are required to keep your client's interest first, ahead of your firm's interest, ahead of your interests. So, you always act in the best interest of the client. So, if you can imagine, if you're managing someone's money, and you may get paid more if you put this client in a particular product or invest their money in a certain strategy, but that may not be the best thing for the client. Now you are faced with a conflict of interest regarding your fiduciary standard. So you should always keep the client first. I think that's a very obvious example, but unfortunately, we do have professionals that do not keep the fiduciary standard or responsibility. So whenever you're working with a financial professional, again, just know that all financial professionals are not held to that standard based on what kind of a professional they are. But as a wise consumer in the marketplace, looking for a financial professional to support you, you may want to ask questions around What are your thoughts about a fiduciary standard when working with your clients? And then allow that professional to respond and see how you feel about their response.
Right. The best response or the worst response, actually, if their response is
Well, I don't have to be held to that. So
right. I'm trying to get that boat in the Hamptons. That's my fiduciary. But it's really important, everyone, to remember when you are hiring someone to be your financial advisor, financial coach, ask them that question, because they do work for you, and there can't be any underhanded way in which they financially benefit from your misery. Please remember that it has to be ethics within any relationship, particularly financial relationship. Now, with Wakiza, our first product is going to allow everyone to, invest in U.S. publicly traded companies. But as the founder, I want everybody to invest and no one to invest until they have a strategy. So how does one prepare, Dr. Dominique, to invest? What should we have established first before we even think about even stock market, or whether it's real estate or whatever it is? How should we prepare ourselves? And just very quickly, I was in Atlanta, entered an Uber, cab, and the driver, he had on a financial course. And I said, "What are you listening to?" And he said, "Oh, I'm listening to an options course. I took an options course. I paid $22,000 for it." I said, "You did what?"
yeah.
And, I said, "I'm so sorry. I'm getting in your business and I just got in your car." And I told him what I did, but I was so sad for him. But I understood the motivation. The motivation for him is, I want to take my family to the next level, and this shiny object called options look like that opportunity. But you would say what, Dr. Dominique?
I would say, first, be willing to invest in yourself. So that is really the first thing. But what does that mean? Everyone is very eager to get to the investing piece where there's risk. So I like to say, let's take a step back and realize everything in divine order. There is a spectrum with our money, and there is a level of readiness that goes into approaching investing. So typically, when I'm working with the client who is interested in investing, and this literally just happened, you get the consultation, I'm not investing and I want to be. Or maybe you're investing in your 401k, but not outside of that. You don't have any other brokerage accounts. You hear about these returns, people are making money, and you're ready to go because you got 5,000, 10,000 sitting over here, or maybe you have 1,000, 2,000 sitting here. And so the first thing I say is, okay, well, what is your motivation? Because it can't be the returns, because that's not how the stock market works. That's not how any investment works. It's not just based on returns, because returns go up and they also go down. So we need to understand that what we're investing in, we could lose it all. So understand risk first. Risk is the possibility of loss, and any and all investments carry risk, just different levels. So we like to start with, what is your risk tolerance? Because every investment is not for you. So you need to understand first, as an investor, your investor profile, what your risk tolerance is. And based upon if you're working with the professional or not, these are things we can actually measure and kind of spit out an answer for you to know. Now,
could you just dive more into your risk tolerance? Because there are risk personalities, whether you're aggressive, conservative, etc. How do I know what my risk tolerance is?
Right. So typically it's measured through a series of questions that are designed to measure your risk tolerance based on investing behavior as well as knowledge. So I would say a series of 10 questions that would ask you things like, how long do you plan to invest this money? And or a variation, um, before, by when would you pull or withdraw this money from the market? Another question, what what would you do if the market were to tank 50%? Would you pull your money? Would you leave it? Would you take partial? These are examples of some of the questions that would be on this questionnaire, getting at your behavior as an investor so that eventually it's going to spit out a number, a score, a profile, so you would know the type of investor you are. The typical categories are conservative, moderately conservative, moderate, moderately aggressive, aggressive. So there are typically 5 major risk tolerance categories where your profile will fit within one of them based on you, your personal situation, your money goals. So you think about that. A young person may not have the same risk tolerance as an older person. Very easy example, right? But also someone facing different life events. So someone retiring versus someone who's at the peak of their career. So you want to be sure that you assess your risk tolerance, and that's as an investor. However, you also need to make sure that you have a solid financial foundation before you get to investing. So what does that look like? First, you need your When I Need It, I Got It fund, aka your emergency fund, but words are powerful and who really wants more emergencies? So I like to call it your When I Need It, I Got It fund. You need to make sure that this fund is funded according to your lifestyle. Now, if you Google it, find articles, they're going to say 3 to 6 months, 6 to 12 months, maybe even 18 months of savings should be in your When I Need It, I Got It fund. I like to work with clients on just saying, let's start with what you can afford because everybody's financial situation is different. And then we'll set goals, milestone goals over time to increase what's in that account. But if you have nothing and you get some money and you're like, I want to invest, but your When I Need It, I Got It fund has $0 or $100, you may want to think about the importance of this 1,000 or 2,000 or even 5,000 before you go and try to invest it. Because why? Really, the only reason is investing carries risk. And if you cannot afford to lose the entire amount that you're willing to invest, then you cannot afford to invest before fully funding your When I Need It, I Got It fund.
So what's the next? I have the When I Need It, I Got It fund.
Okay.
Locked, have at least 1 year emergency that I don't touch, and it's in a high interest account.
Yes.
Somewhere. I've done the research to find them.
Right.
What's the next step in terms of my strategy?
Okay, so I would say, okay,
Doctor, should we invest at all? Should we invest? Does anyone need to invest at all?
Great question. Again, I say this goes back to your motivation.
Okay.
Because we're all different. Money is personal and it is behavioral. I would think that investing is one of the only ways that we will achieve a certain level of freedom, because you cannot just save your way to a certain level of freedom without risk playing a role. Well, what kind of risk if I'm not investing? It's what we call systematic risk. One of those systematic risks, and there's typically 5 of those, but one of them is called inflation or purchasing power. So you may say, well, investing is not for me. I don't need it. I'm a great saver. I'm a high income earner, or I save everything, so I'm going to be fine. That is one perspective, and you may accumulate a lot of money. But depending upon how much money you're earning in that savings account, if it is not beating inflation, your money is actually erosion, just like it does with land and water. The land can erode. Your money is eroding in its ability to purchase things for you. So yes, you may have, you know, 200,000 saved, but if you're earning 0.05%, not even 1%, and inflation is 3%, 5%, 6%, like what we're seeing now, guess what? You're actually losing money in that account because that $1 cannot buy what it used to buy. That $1 may really buy $1.07 worth of something. So when you think about the savings piece, yes, I can save, but you have to now accelerate your savings. And that's where investing comes in, because investing offers us much greater returns on the upside than a typical savings account. So I answer your question by saying, if you have a goal to achieve a certain level of financial freedom, yes, you should consider investing.
Okay. What's next?
All right. So now the strategy, you got your savings and your when I need it, I got it fund. I would say make sure the other areas of your foundation are solid. Again, everything in divine order. So do you have your retirement down? Unless you're saying, hey, I'm not, that's not my priority. I want to go straight to investing. Fine, but there are 5 types of savings. When I need it, I got it. Your regular or goal specific savings. So anything and everything that you ever might want to save for, are you saving for those things actively? And then your retirement, pre-tax and post-tax. Let's have a plan for both, because you will likely be responsible for your own retirement. And then there's investments. And your 5th type of savings would be business savings if you're an entrepreneur. So if you've covered these 5 types of savings, and if you're not an entrepreneur, 4, then you're ready for investing from a financial perspective, because you've got the other areas accounted for as well. So now you might say, okay, well, I have that year of savings in my when I need it, I got it, and I'm not making a high interest. It may not be sitting in a high interest bearing account. Let's take maybe a fourth of that and put it to work in an investment account. So now you don't put all of your savings into investing. So that's one way to mitigate your risk. The second thing is, now you have an opportunity to let this money work for you. And one of the easiest ways to do that without taking on much risk at all is to put it in a high interest bearing account if it wasn't already. Because high interest bearing accounts, typically high yield savings accounts, are invested in low risk securities, which we would call risk free, because they're typically invested in government agency bonds. And a bond is a security. So I always encourage clients, as a way to get in with money that you still don't want to necessarily lose, but to be an investor, you could just put some money into a high yield savings account, which is what we're seeing right now, given the high interest rate environment that we're in. But when you're ready for the next level and you are ready to say, okay, I'm ready to invest in some companies, some real estate, some bonds, some mutual funds, some ETFs, those types of securities. Now we need to build you a portfolio, just get an understanding of what's important to you, again, based on your risk tolerance as well, because whatever your risk tolerance is, that's what's going to help guide you towards the securities that are a good fit for you. So this is where like the world of securities becomes a little bit more narrow now that we take into account your risk tolerance. So maybe real estate as a property is not within your risk tolerance. So maybe you would consider something like a REIT instead, because you could still invest in real estate, but it has a different risk profile than going out and purchasing an actual property.
And what is a REIT? Explain, please.
Okay, so a REIT is a real estate investment trust. It is a security that you would invest your money into. And it is basically a way for investors to mitigate their risk when investing in real estate by investing in companies that are in the real estate industry and not having to own the physical properties associated with those companies. Mm-hmm. So this gives you options as a real estate investor that you may not have known about. you know there's a physical property you can go out and purchase and maybe use for rental income and hire someone to manage the property and get you some tenants. That's a whole thing. But what if you don't want to do all of that? That's where a REIT could be a good alternative to consider. But of course, doing your research, understanding which REIT is still within your risk profile. But now you have an alternative to investing in real estate outside of an actual property. So this is where your world of investments again begins to get a bit more finite. It begins to get more narrow and targeted to your profile, to your goals, to what you say you're trying to accomplish by even investing in the first place. So what may have been a consideration before is no longer a consideration because it's not in my risk profile. It's outside of my time horizon. Maybe it's outside even your investing budget. So the more clear you get around your profile, it helps target the actual investments that you should be considering to invest in.
We're here with Dr. Dominique Reese. She is the owner of Reese Financial Services and Training Solutions. Yvette asks, I don't allow brokers to charge me a percentage unless it's a specific fee. Are broker fees negotiable?
Are broker fees negotiable? That is going to be dependent upon the broker. I say everything's negotiable until I'm told it's not. So, that's really where the consumer has leverage, especially if you're knowledgeable about the property and even being knowledgeable about the broker. I mean, you can see past deals. You can look up paperwork. You can see some of these earnings that are associated with these sales that brokers do. So I think that's where you get your ammunition to be able to leverage negotiating with the broker. So standard answer, everything's negotiable until someone tells me it's not.
Everyone begin posting your questions or comments for Dr. Reese. So let's say that I'm considering investing in a particular company. How should I gauge? What criteria should I look for whether that company, beyond the financial return, aligns with my values?
Great question. So I think right now too, we're in an environment where there are different themes of investing, and there are different considerations that people can consider when choosing a company. It's becoming more popular. And I call it theme based because if you're, let's say, concerned about, for example, the environment, which is a very trendy and popular example right now, and you want to be sure that the companies you're investing in are also eco-friendly, are green, um, practice biodegradable practices, you can research those companies to find out. However, this is becoming what's called sustainable investing. Like it's a themed type of investing now where people do want to align their personal morals and values with the companies that they are identifying to invest in. And so it's a thing, and anyone can do it. You can totally make a decision to invest or not invest in a company based on their practices, even based on where they operate, how they pay their workers, the rate that they're paying. I mean, a lot of these kinds of issues are coming into play, especially when you're seeing like a lot of labor union strikes and employees striking for this or that. And then you've got companies in different countries where maybe farmers are producing crops, and there may not be humanitarian practices in place. A lot of investors are looking at these kinds of considerations to decide if they're going to put their money into this company to then help that company grow, open another plant, launch a product, do research, because those are typically the reasons why a company would ask you for its money and become a shareholder so that they can expand. But you have the leverage now to say, well, I kind of don't like the fact that you supported X, Y, and Z, or you didn't support X, Y, and Z. And so that makes the marketplace a bit more selective for you as a consumer.
Hmm. So, what do you think about the encouraging everyone when they're considering investing to look around their homes?
This is a great
Start start with what you know. If
yes,
you, for generations, you and grandma have bought, the Sears and Roebuck, uh,
yes,
stereo. I don't even
yes,
know there's such a thing. Maybe consider, since you're already a consumer,
yep,
that's your relationship with that company. You're already a consumer.
yep.
So maybe you're already investing, but only from a consumer standpoint. Talk about that, please.
Yes. So I am the founder of the Black Women's Investment Club. And once the whole premise for me was to attract Black women who don't think they can invest because they don't have a lot of money or they don't know enough. And one of the strategies that I employed with our business, because it is a business, was to encourage them to look around their homes, list 10 companies that they already have products and or services in their homes. So it could be from your telecom, so your internet provider, your cell phone provider. Let's go to the kitchen. What are you cooking on? What kind of stove do you have? Where's your food store? What kind of refrigerator do you use? Do you have a coffee maker or do you purchase coffee? Let's go to your bedroom. Are you purchasing your furniture from a store like Target, or a Walmart, a Sam's Club? Like, where are you buying things from? Look in your wardrobe. Do you care for Jordans and Air Force Ones? Because if so, Nike's on the map. Adidas. Where are you currently already spending your money with a brand? And after you make a list of at least 10 brands, the next step of your homework is to go research if that brand is a publicly traded company or if they are private. If they are publicly traded, that simply means you can now invest and own a piece of that company. So, to your point, you're already in a relationship with this brand, but as a consumer, investing in the company now puts you on the other side of the economy. You're now a producer. So when that company does well, you do well because you have ownership in that company. And that is what investing, at least through equity, gives you. Equity represents the ownership. So now you can participate in the economy as a whole on both sides. You're a consumer, yes, because you spend your after tax dollars with them, but you're also an investor, which makes you a producer in the economy, and you own a piece of what that company is doing. So there is no bad economy for you.
Thank you. We're taking your questions for Dr. Dominique Reese. Tony Scott's asking, what do you think about bonds as inflation rises? And would you include in that answer, it seems like the word inflation and all of these hysterical terms it's built in media propaganda, and inflation always existed. So but talk about that, please.
Yes. Okay. So inflation has always existed. And I mean, until we hit a point of deflation or stagnation, it always will. And it is simply the rise in prices. That is all inflation really means. It's when we see a rise in prices. Okay. So, Tony, to your point, the relationship between bonds and inflation or even higher interest rates, they have an inverse relationship. So, when interest rates go up and we're seeing high inflation like we're doing right now, bond prices go down. There is an inverse relationship. So, for example, if I already own a bond and it's paying me 5% and inflation increases or even interest rates go up. So now interest rates are higher, the bond that I have in the marketplace, that bond price is going to drop. Why? Because I can go out and purchase a new bond for a higher interest rate. So this one is worth less in the marketplace. There is an inverse relationship with bonds and high interest rates. So, again, based on your investor profile, based on your goals, you may have a portfolio with bonds and may see a decrease in the value of those bonds right now because as interest rates continue to go up, new bonds may be issued at a higher rate, which again as an investor you're like, well, I want the higher rate bond, so you're willing to pay for that one compared to a bond that's been in the marketplace with a lower interest rate. You may not be as willing to pay for that. So the price of that bond would then decrease. True supply and demand with respect to that relationship. I think bonds are a great security. You use bonds typically to hedge. You also use them to preserve. If you are a conservative investor, your portfolio may have a majority of bonds if you are worried about preserving your cash and your assets, not as much growth. And then there are various types of bonds. So even in your question, it's like, well, what kind of bonds? Government bonds, corporate bonds, municipal bonds, which are typically the various types that you can own directly from the government, which typically are the safest, still carry risk, but are the safest. Then you have corporate bonds, which typically can be one of the riskier ones because what if that company goes out of business? And then with municipal, that's your state. Now we're talking state level, which have a great perk because they're not taxed on the federal level. And if you purchase a municipal bond within the state that you reside, you also don't have to pay state taxes. So investing in a municipal bond helps you avoid taxes on any of the money that you earn from that bond. So depending on the type of bond, there's levels that you can dive into, but the general relationship is as such that I've described, where it's an inverse relationship. I think they're great securities based on your profile.
Mm-hmm. Less than 6% from the studies that I've researched, Dr. Reese, less than 6% of African Americans purchase or rather participate in investing in U.S. publicly traded companies. Less than 6%. And I believe that to solve that, close that gap is really based upon education. And it may be a little bit of fear of loss, that sort of thing. But that's why we drive at Wakeza and World of Money for Children, World of Money's for Children, Wakeza's for adults, this education and bringing in experts like Dr. Reese. Denise Fun asked if your favorite brand offers crowdfunding. Would this be a good way to invest? And add on to that, your best friend should be diversification.
Yes. Okay. So diversification, I'll just start there, is a strategy. It's a strategy we use to mitigate our risk, right? So you don't want to own a whole lot of one thing or a whole lot of another thing. You want to own a lot of the little things, right? You want to be able to diversify, spread the money across different assets or securities that don't necessarily correlate to each other. That way, if one industry takes a hit, you're invested in something that has nothing to do with that industry. So it will kind of balance out the value of your portfolio. And versus you taking a complete loss, you're actually sustained because you don't have all of your assets in that one industry. So that's like an example of diversification and how it works. We're just mitigating our risk. We're spreading our risk around. We're investing in different things. Now, going back to crowdfunding, if your favorite brand is crowdfunding, the first thought I'm having is, I wonder if this is a small business, a startup business, because that could still be your favorite brand. And now you're supporting them in their expansion. I say, again, based on your risk tolerance, it could be a great investment because this is how a lot of companies start. They ask you as the consumer to, and let me just say, crowdfunding is even, I don't want to call it a new phenomena because it always existed. It just only existed amongst a certain tier of investors.
Mm-hmm.
So now it's on the main street level for us to participate in the brands that we believe in. And from that perspective, If you've believed in a company and they're now asking you for support and you get some kind of ownership, that is one thing to consider. However, all crowdfunding is not equal. So they're asking you for something in exchange, but make sure that you understand what the exchange is. Is it actual equity or is it something else? Because on these crowdfunding platforms, there's options. So a company could actually offer you equity, or they could offer you like a discount when the product actually launches and you're the first to get it. So, based upon how the crowdfunding is set up, be sure that you understand all the terms. And then, if it is a company you believe in and you can stand to lose that money if that company did not do what you expect it to do, because again, all investing carries risk. What is risk? The possibility of loss. So, if that company completely tanks or just never takes off and you've invested 1,000, say goodbye to that 1,000 and be okay with it. If for whatever reason that would not be your situation, that if this company did not make it or did not take off and you needed that 1,000, then you cannot afford to invest that 1,000. The other thing about risk and loss is that it's not necessarily immediate. So I also want to nuance that part of the discussion by saying it's not just about the whole possibility of loss, but also the time horizon. If you're going to need this money in like 6 months, you should not be investing it, because it's going to take more than 6 months for this company to even get it going and be able to pay you back. And you will not be amongst the first to get paid back based on $1,000. So it's not just about the possibility of loss, but it's also about timing. So you want to consider, if you can't afford to go 6 months without this money, then you are not ready to invest that money. And to answer the question more directly, crowdfunding is a great way to invest and get started if you can stand the loss. Because typically these are startup companies that need to crowdfund, so they have a higher risk profile. They're new. They don't
Mhm.
have a track record. We
Yeah.
don't know what they're going to do. So you're really all in on, I guess, just really being sold on the projections, the idea, the vision. Maybe you believe in the brand, the founder, and you're gun ho. So those are the things that we consider when making the decision. But again, it's a great way to get started.
And by the way, please like and share this broadcast wherever you are beaming in from. And I appreciate you for doing so. What is in the 7 minutes we have remaining? What is a bear market and
Mhm.
what is a bull market? And can you make money in either market?
Oh, yes. Great question. And this goes back to my comment earlier when I said there's no bad economy when you are an investor. So, a bull market is the market everyone gets excited about. It's when prices are going up, the stock market numbers are going up, everything is all the way up, right? And we don't necessarily know when it's going to come down, but we are riding the wave on up. Everybody's doing well, money is being made, expansion is happening. Bear market, not that at all. Think of a bear. A bear is what? Gonna go hibernate at some point. So when we hit a bear market, things are coming down. How far down? We don't know because we can't predict the market. That's called market timing, and we don't do that. Um, and you just kind of have depressed pricing. No one really likes it. Some people are losing money based on their strategies, and we may not see everyone doing well. Could be a contraction happening in the economy. I mean, we sort of saw a bear market during this unprecedented pandemic that we've all made it through. So we now have a living example of what it's like to live through a bear market. And those are some of the typical characteristics. You can make money in both markets. There are strategies within investing. I'll give you an example as education, where you buy a stock, that company does well, you now have ownership in that company. You buy at $10, it goes up to $12. It goes up to $15. And this may be over months, this may be over years, but the stock appreciates. So you make money when the stock appreciates. Another way to make money is if that company pays a dividend, which is basically a quarterly payment issued to you from the profits from when they did so well. So they issue that back to the stockholders. Now, in a bear market, when you can imagine prices are depressed, prices are going down, it's like, well, how would I make money? This is where investing strategies come in, one in particular called shorting. And when you short a stock, we've seen an example of this as well with AMC and GameStop, which was pretty cool. I mean, it was radical, but it was really cool if you knew it was happening. Um, but this is when you actually believe a company is not going to do well and you bet against that company. So you short the stock. And when you make money in shorting, it's literally when the stock price is going down. So that is an example of how many people profit during a bear market, which goes back to the comment I made. There is no bad economy ever. It simply depends on what side you find yourself.
Repeat that again, because we get a lot of people repeating what's coming out of the television set. It's inflation. It's always inflation, homie. Repeat that again.
There is no bad economy. It truly only depends on what side of it you are on. And if you really think about it, the sayings are sayings for a reason. Birds of a feather flock together. Well, if you're around people who are in the same situation as you or worse off, meaning they may not be investing in the stock market, okay, they're losing. They're hurting when things get bad. But if you are around other people who are investors and have any level of knowledge, it doesn't even take a lot, but are actual investors and have a different set of people with whom you can consult with, you may pick up a strategy to make money when everyone else might be losing money. And again, shorting a stock is one example. Options are another. It gets a little bit more complicated, but these are strategies that are available to all of us. The only thing is whether you know them or not, and if you've tried them to actually understand how they work. They're not hidden. They don't require you to have a certain income level. So again, there is no bad economy. You just need to know to play for the economy that you're in. And you do that by staying and getting educated.
Excellent. And the worst reason to invest is because your cousin on your father's side told you to. And the other reason is FOMO, the fear of missing out. And Wendy Royster asked, are Stash and Robinhood ways good start to learn? I would say you're home at Wakeza, because those companies, well-intentioned and they're doing very well, less than 3% of African Americans, participate with those apps. Wakeza is here to serve our community. So in our 1 minute remaining, Dr. Reese, and thank you so much, as Tony Scott said, for breaking that down.
You're welcome. This is the
Tracy
stuff I love.
Holder is saying, how can I reach Dr. Dominique to talk about, well, you see what she says about possibly being my financial advisor. She says, I have when I need it, I got my money and I'm ready to start investing. So take it away. You have a minute just to tell us where you reach us and any other brilliant nuggets. Thank you.
Absolutely. So first, since this is going to be streamed, you can find me on YouTube at Reese Financial Services. However, old school, call me 323-815-9519.
Repeat that.
Email.
Repeat that.
323
Wait a minute. 323.
815
9519.
That is my office line. You can't text me there. That's the office line. Email Dominique, DOMINIQUE at Reese, REESE, financialservices.com. Dominique at reesefinancialservices.com. And then the website, reesefinancialservices.com. And I'm on social and I'm Googleable. So just Google me and you'll find me on all the socials. But hit me up directly. I like it like that.
30 seconds. Any other nuggets you like to leave us with that I did not ask you?
Everything in divine order. Always assess where you are compared to where you want to be. There is no bad economy. What you don't know can hurt you. Don't be afraid to invest in your education. And if you've taken yourself as far as you can go, the next step is to hire a professional to partner with you to get you to your goals.
Tony Scott asked the final question. Would you recommend seeing the Dumb Money, the movie?
Listen, Tony, preference, right? You ain't got nothing else to do. Why not? Check it out.
I'm going to wait till it gets on wherever.
Right.
So anyway, so thank you again so much, Dr. Dominique. Everyone, all the information to contact Dr. Dominique is in the chat. And thank you for joining us. So until next time, we have very, wonderful guests that are coming up over the next few weeks. So stay tuned for those notifications and like and share this broadcast. Yes. Until soon, everyone, live long and prosper. I'm Sabrina Lamb.
Yay!